Hey guys, this is Mr. Roxy coming at you live from Palm Beach in Florida. It is Saturday. It is January the 1st. Happy New Year to everybody. And I hope that 2022 is going to be a spectacularly successful year for you. I wish you good health and happiness and all those good things. Take care of yourselves and let's make it a good year. What I want to do today is kind of touch on a question that Joe Huerta had posted to the channel. I think it was yesterday, maybe, or the day before, and Joe basically just asked the question, what's the difference between selling and rebalancing? And my reply was, well, selling simply means exiting a position, whereas rebalancing is obviously something completely different. So by way of just a simple illustration, if I owned 100 shares of Occidental Petroleum, and let's say I purchased those shares for $20 and I sold them for $30, I would book a taxable gain of $10 per share. I've exited the position or closed the position, and then that's the end of that. Obviously, I could also sell just a bit of it. In other words, I don't need to sell it all. And sometimes you might even sell them at a loss, but more about that in just a second. So let's talk about rebalancing and what this really means. And I'm going to give you sort of a quick snapshot here in terms of some of my accounts in my portfolio. And many of these stocks are going to be familiar to you because we speak about them all the time and discuss lots and lots of different comments and things as we go through my video channel and the discussion that follows in our community. So in this portfolio here, number one, I have 28% Occidental, 22% AllianceBernstein, 17% Energy Transfer, and 17% ICANN Partners. Now, at a glance, you can see that I'm kind of maintaining a sort of similar position on Occidental and AllianceBernstein in the 20% tile range, and on Energy Transfer and ICANN, about 17%. So from a balancing point of view, I might say, you know what, I have a little bit extra Oxy compared to AllianceBernstein, and might balance those out a little. I could sell a little bit of Oxy, or otherwise I could buy a little bit more of AllianceBernstein. Depends on what my objectives are with this particular portfolio. How about portfolio number two? Not the same stocks at all. In this one, I have a mix, which is almost the same of BNS, which is Scotiabank, or the Bank of Nova Scotia. It's a Canadian bank. Then I have Total Energy, which is a French super major in energy. And I have 3M, which is an industrial conglomerate. And then I have AG&C, which is a REIT, a real estate investment trust. So portfolio number two is quite diversified. And by the way, I'm just showing you sort of the top holdings in these portfolios. There are other stocks in the portfolio as well. But in this particular example here, I have approximately 20% Scotiabank, Total Energy, 3M, and AG&C. And together, these four stocks make up almost 80% of the holdings in portfolio number two. So again, from a rebalancing point of view, I might look at these from time to time and say, you know what, I could probably add a little bit to AG&C and bring it back up to about 20% in line with the rest. Or I might say I could trim a little bit of Scotiabank. By the way, these are all long positions that I'm discussing with you now. And many of the stocks, as I said, would be familiar because we talk about them frequently. Portfolio number three has a little bit of a different diversification across a couple of different sectors as well. Firstly, we have, from a financial sector point of view, once again, AllianceBernstein. As you could probably tell by now, it's one of my favorites because there's 15% here and there's 22% over there. Wells Fargo has a position of 15% in this portfolio. ICANN comes up again. Very often, if I'm parked in a position like ICANN, it's just to collect the dividend. And Energy Transfer is a bit of a mix. I'm collecting the dividend and I'm expecting good growth. But AllianceBernstein, Wells Fargo, Energy Transfer, and ICANN are sort of equal weighted in the teens. There's AG&C again at about 10%. And then there's two new positions, which I discussed with you guys over the past few months or so. Sibanye-Stillwater, which is a mine, now occupies 6% of this particular portfolio. And Petrobras, another energy stock that pays a lot, a nice high dividend. And that one is at 6% as well. In this particular portfolio, portfolio number three, rebalancing for me might mean that I might look to add to Sibanye-Stillwater and maybe to Petrobras, as opposed to necessarily trimming some of the others. If I do trim of the others, it would be off the top. So maybe take a little bit of profit in AllianceBernstein and in Wells Fargo. But remember, if I book a taxable gain, I have to pay tax. So come back to that one in just a second. How about rebalancing by region? you can see that most of the equities in this particular account, and this, by the way, is another portfolio account. On this one, 86% of my holdings are equities, and 86% are in North America. North America in this particular definition is specific, the United States, specifically the United States and Canada. In other words, I'm saying North America, but this is not my definition, which North America would include Mexico. I don't have any Mexican stocks in here. 86% of my holdings are United States and Canada in this particular portfolio, and the pie chart you can see next to it. The smaller holdings in this particular portfolio are actually not even stocks that I hold directly. It would be an equity like an ETF, where the ETF is invested in some other stocks. You can also rebalance by sector if you'd like. And in this particular example here, this is my holdings in financial services, 50%, and in energy is 30%. Now you could say, Mr. Roxy, why would you be 50%? By the way, this is one account. This is not my entire portfolio. Why would you be 50% in financial services and 30% in energy? Because those two together is almost 80%. The reason is that energy and financials were the most oversold sectors and underperforming sectors in the S&P 500 for the past year. That's why most of my holdings are in energy and financials. As the market shifts, so my investment thesis and my narrative might shift, and I might start adding more stocks in the other sectors where I am currently light. But for now, and for the past year, I was very happy to have most of my stocks in energy and financial services. And then, of course, I'll also hold cash, which doesn't come up on this particular pie chart here. So half of it in this particular account is financial services, and the rest is energy. How about rebalancing by asset exposure? So once again, 80% almost of my investments are equities. I have 15% in ETFs here. I actually only own 2 ETFs in this particular account. One is VYM. I have a large position in VYM, and I have a slightly smaller position in SPY. Those are my 2 ETFs, and that's why I also have exposure in some of the smaller equities that I mentioned just a minute ago, where I actually don't own the stocks directly. However, 78% of my positions in this particular long portfolio is equities, and I hold 7% cash. Why do I hold 7% cash? You got to keep a little bit of powder dry for when one of these dips quite significantly, I might pick up some more. As a general rule, my cash position is between 10 and 15%, so 7 is a little light on cash, which means I've been doing some buying, which I have also shared with you over the past couple of videos because I added to some of my positions, including ICANN, AllianceBernstein, and Energy Transfer, and some others like Petrobras and Sibanye-Stillwater. How about rebalancing by performance? So if I look at this particular account, and this is one of my accounts where the splits are, as I just mentioned, financials, energy, and an ETF. So in this particular account for the past year, I have TD, which is a Canadian bank, Toronto Dominion Bank. I have Sun Life, which is a life insurance company also in Canada, SLF. I have VYM, which is a US ETF, and the Vanguard High Dividend Yield. VYM specifically pays a dividend of almost 3%. And of course, it just tracks the market. So it kind of gives me a bit of a hedge as opposed to picking individual stocks. Enbridge and PPL, or Pembina Pipelines, are positions I've been in for a long, long time. And even though their performance over the past year have not been that great, they also both pay me a dividend of almost 7%. And in the case of Pembina, it pays that dividend, the annual 7% yield on a monthly basis. So every month I get a little deposit into my account from those. But you can look at the performance. You can say TD Bank has outperformed all the others, and you can rebalance by performance if you want to. I hardly ever do that. You can also rebalance by looking at your gains and losses. So you can see, as I've said many, many times before, I hardly ever sell. There's a realized gain over here. This was actually an ETF that I exited, which includes, which specifically in this particular transaction in September was SPY. So I booked a bit of profit on SPY, and then I added to a couple of small caps or smaller companies like Sibanye-Stillwater. I also added Harbor Energy, and I added some, what was the third one that I bought? Oh yeah, Petrobras. So you can rebalance by this, and I'll just pause here for a second because I want to talk very briefly about tax harvesting. So earlier in the year, might have been just at the end of my North American summer, so sort of in August or so, maybe September. I exited my most expensive Occidental stocks. At that point in time, Oxy was trading at about $30, and my most expensive Occidental stock was about $53, $54 per share from a long time back. Maybe more than 2 years ago, I bought into Occidental and paid more than $50 a share on those shares. So I sold them when Oxy was trading at $30 a share, which means I took a $20 loss per share. And I could use that loss to offset against the gains that I made when I sold out of a little bit of AllianceBernstein, SPY, ICANN, etc. So I had a gain on one hand and a loss on the other hand. The one offsets the other. It's a wash. I rebalanced my portfolio and end up with no tax liability from cashing in those gains. How about rebalancing by indices? So this might be interesting to some of you. We've had some discussion over the past month or so about the Chinese market, the macro. We talked about Evergrande and their financial collapse and what that means to the Asian markets as a general rule. Well, here's the snapshot, right? And when you look back in the rearview mirror, the snapshot does not lie. This is the top three lines over here are respectively, the purple one is the NASDAQ, the turquoisey one is the Dow Jones, and the light blue one is the S&P 500. And you can see the S&P 500 ended nicely for the year. I think it was 27% or so for the year. But look what happened to the Hang Seng, right? So you can rebalance by indices as well if you want to do that, because you can say China is hopelessly oversold, the market and some of the equities have pretty much collapsed. Let me pick up some bargains, add them to my portfolio, and hope to see an uptick over the next year or so from China. So that's a possibility too. So I'm giving you a whole variety of different reasons or methodologies that you can deploy or employ when you want to rebalance your positions. So here's a look forward. So CFRA, the analyst company, will release this on January the 3rd. So today is January the 1st. So you will be able to retrieve this on January the 3rd, or otherwise what I'll do is I'll put a Google Drive link below the subscription of this video. So if you wanted to pull down this Outlook report from CFRA, which is about 8 pages, you can just download it from my Google Drive link, which will cost you nothing, and it'll give you a quick insight into what 2022 looks like according to CFRA. On Monday, December 27th, that marks the start of the Santa Claus rally period, popularized by the Stock Traders Almanac, which measures price performance of the equity market during the final 5 trading days of the current year and the first 2 of the coming year. Since 1945, the S&P 500 enjoyed a favorable price change in the 7-day period for more than 3 out of every 4 years, rising an average of 1.2% in price. The January barometer, should the S&P 500 go on to record a positive performance in the entire month of January, it has historically enhanced the possibility of a positive full-year performance. Why does this matter? Well, you could argue that in the greater scheme of things, it doesn't matter at all. But there are people who track the movements in the market based on certain events all the time. One of the other ones that is quite interesting is the Fed minutes. So when the Fed get together to have their meetings, as a general rule, you can say what happens before and after the Fed meeting. So 68% of the time, so nearly 70% of the time, if the market was trading negative before the Fed meeting, it went positive after the Fed meeting. And the reverse is also true. If the market was positive before the Fed meeting, nearly 70% of the time, it went negative after the Fed meeting. So, you could say, hey, you know what, that's just coincidence, it's meaningless stuff, but it's interesting anyway. CFRA has a particular focus on AllianceBernstein, which I already mentioned to you is one of my top holdings in my long portfolio. In addition to the fact that it's been a good performing stock, it's also paying me a very healthy dividend. Our buy recommendation reflects the view that the shares are undervalued versus the peer and historical levels. We think the progress AB has made in increasing the management fees, overall organic AUM is assets under management, etc. That's the bull thesis. Risks, so on the other side of the equation to our recommendation and target pricing, include long-term retail outflows, out of actively managed funds into ETFs, etc. So the CFRA report kind of gives you, firstly, they highlight AllianceBernstein, which is kind of cool for me because I'm long AllianceBernstein. Secondly, they tell you what the sort of bull thesis and bear thesis is, respectively. What do they expect the price target to be? So this is their top picks in terms of small to mid caps. Currently, you can buy AllianceBernstein at around $49. Actually, I think it's trading lower than that. It's about 47, 48 bucks. The target price is $60 over the next 12 months. And as I mentioned, you also get a dividend of about 70%. Cleveland Cliffs is one of Mr. Robert Burke's favorite stocks. Nice target price here. The recent price about 20 bucks. The target price 12 months, $43. I hope that one works out well for you, Mr. Burke. I think that would be awesome. How about industry momentum? So a couple of energy stocks here on the CFRA report. Devon, of course, has been an outlier. It's had a phenomenal performance over the past year. Target price now $56. People who are long in Devon would like that one. ExxonMobil as well, $74. Just a few months ago, I made a video on Exxon when Exxon was trading at about $50, and I said I wouldn't even buy Exxon with your money. So anyway, so we see Exxon going up here to 74. If it is that target, then from the time I made the video when it was at about $50 a share, it would be up almost 50%. Marathon's been a good performer, but they don't expect too much movement on this one. It's currently trading at around 60 something, and the 12-month target price is only 66. So not great expectations on that one there. So guys, that's kind of like an overview of rebalancing and some interesting little factoids and a look ahead at 2022 from CFRA. As usual, if you like my content, please subscribe because it keeps me motivated to do more of the same. And I look forward to your comments because as a general rule, your comments are more valuable and have more interesting information than the information that I share with you in my video. But on that note, it is still New Year's Day. Happy New Year to everyone. Have a great 2022. I look forward to your comments and I will see you soon. Take care. Bye-bye.